This episode is brought to you by Raymond James. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors. They've got $88 billion in assets under management and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Now, whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Remember, we're doing our CEO Summer Series, and this episode features Kevin Strain, the CEO of Sun Life. Now, you might think of Sun Life as an insurance company, but they've been quietly building a huge asset management business that actually rivals Brookfield. We talk about how this 160-year-old company plans to keep it fresh for the next 160 years. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decision. Thank you to our partners at ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Kevin Strain, thank you so much for joining me.
It's great to be here in person, Amber. And thank you for being the co-host or the co-presenter at the Canada Club a few weeks ago.
That was really fun. We got a chance to do a fireside chat about kind of the state of the world. And the world felt very precarious then. And I guess it feels kind of precarious now. But we also got to learn a lot about Sun Life. You know, the insurer, I don't even know if that's fair to just label
asset
you.
Management.
Yeah,
Sure,
asset management. You do so much. But I want to start at the beginning, as I always do with my guests. You know, you're a 5-year-old boy and you say, Mom, I'm going to be an insurance man. You watch.
I never said that. I'm pretty sure of it. But
how did you end up here?
I was a co-op student at the University of Waterloo because that was the way I could pay for school. And I did want to be an accountant from a fairly early age. My dad had a small business. And from the time I was about 14, I did his books. So Saturday morning, I had this big spreadsheet of paper and I did his books and I learned how he did his invoicing and the cash flow and how the cash flow worked. And I was pretty good at math. And so I knew I could do this. I knew I could get a job at it. But I needed to pay for it myself. My dad had a small business, but it wasn't extremely successful small business. So going to Waterloo was a way that I could pay for it. And I ended up working at Ernst & Young, Clarkson Gordon at the time. And I did all of my co-op work terms there. So I did 5 work terms there, did my master's degree in accounting, and did 4 years afterwards. And London Life was a client of mine. And so I was, in those days, you could go to your client and they had liked me from the time I was doing the audit work, and they recruited me there. And that's how I became to the insurance industry. I always say to people, you don't pick the insurance industry, it picks you.
I mean, it sounds like it scouted you from when you were 14 years old to be like, that's the guy.
Yeah.
And so now you sit atop Sun Life. And again, I said insurance, but, just talk to me, in a short way about what Sun Life has become and what it means, because it's a Canadian company that spans across the globe. And I don't think a lot of people know how long it's been around.
No, we're a 160-year-old company. We started in Montreal and we almost immediately, over 130 years ago, became global. We moved to the US. We started in the US. We moved to Asia. We moved to the UK.
Like 130 years ago, moving to Asia.
So the CEO of Sun Life at the time used to go visit the countries, and it wasn't like today we could do a video or we could get on a plane and, it's 15 hours, but you're still there in 15 hours. He used to get on a boat and he'd be gone for 3 months.
You wouldn't hear from the
just wouldn't come. Yeah, he was gone.
Hope he made it.
He would visit and then they would come back. And even in the start, apparently the person who went over there to run the business would take a stack of policies, and they were following the old Commonwealth shipping routes. And they would take a stack of policies and they would write the policies, and they were in Singapore and Hong Kong and India, and they sort of followed those shipping routes and the UK and the US. And I think it's brilliant when you think about it, that somebody 130 years ago was thinking about being a global company. And we're actually in less countries now and we're in 28 countries now than we were then, which is wild. We were in a lot of the Caribbean countries. And so it's the foresight there of, sometimes I wish Canadian companies had more foresight today to say, we're going to get out there. We have all this technology that makes it doable. We have all these resources. We have these great people. Can we get out and do more? If we were doing it 130 years ago, why can't we do it today, right? And so that's something I look at and go, wow. For most of our history, I'd say up until the last 10 years, because despite the fact that we owned MFS, in the early 1980s, we were mostly an insurance company, and we were a bit of an insurance company that owned MFS, and we integrated MFS into some of what we did, but we never thought of ourselves as an asset management company. In the last 10 years, we've really changed our thinking, and we've been systematically building out our asset management capabilities. And now we're 1.5 trillion in assets under management. We're Canada's biggest asset manager. We're bigger than Brookfield. And it's a remarkable thing, but people still don't know that we're also an asset manager and an insurance company. And I think in a Canadian
they'll know
way,
after this podcast.
Yeah, this would be great.
I think that's so important to discuss because this seems like a trend. Just like expansion, global expansion is not a trend for Sun Life, but is certainly being talked about now. It seems like insurance companies are working really hard to no longer just be insurance companies. Like, what's happening to the model? Why is becoming an asset manager the new strategy?
It's a great question. If you went back before there were asset management companies, in many ways, the insurers were the original asset managers, because the banks were like 50, 60 years ago, the banks were deposit takers. So they took cash and they did loans, and that was their business model. Insurance companies took cash and they held it to pay policies long in the future. So we were one of the original investment sort of organizations, not asset management because we didn't take it to third parties, but investment organizations. So we were investing in equities and real estate because it was long-term. We're investing in bonds and fixed income vehicles because
we had this money until you had to pay it out.
Yeah. And we had liabilities that we understood the cash flow. So we were actually cash flow investors. So we had cash flows that needed liabilities that needed cash flow for 50, 60 years. And so we needed to find investments that had cash flow as long as we could. And that's where equity and real estate come in. But sometimes they're short term, and it came that way. So we were, in many ways, we were the original asset manager, but we never thought to bring it to third party. And that's, I think, where the asset managers came in, and they started to bring it to third-party investors, right? And pension plans.
Meaning
and institutional
funds
investors.
Can invest with you.
Right.
You're not just investing your own money.
Yeah. Now we're looking at that going, we have all these capabilities. Why aren't we bringing it to institutional investors? And then the next stage of that is, why aren't we bringing it, even more of it, to other retail investors? So we're bringing mutual funds and we're bringing ETFs, but can we bring real estate, and can we bring private credit? Can we bring private fixed income and infrastructure to retail investors and other third parties?
You sell insurance to a policyholder, to a business. Are you now wrapping around and saying, hey, while I've got you here, what about these asset management services? What about some net worth?
It's a great question. In fact, I ran our individual insurance business from 2007 to 2012 here in Canada. And when I started running that business, I looked at our most successful advisors, and our most successful advisors were selling life insurance and health insurance, but they were also selling wealth management. And they were selling it in a holistic way, in an integrated way, to sort of say, we're here for your lifetime financial security. But to have lifetime financial security, you don't get that if you only own life insurance, if you only own health insurance. In fact, you don't get it if you only own RSPs or mutual funds. You have to have a plan that covers all of that. And we started on that journey for retail investors in Canada, probably in early 2007, 2008 kind of timeframe. And we've been trying to perfect that. We are the largest player in group benefits and group retirement services in Canada. We've started to create this total benefits where we could bring those things together. And I think now we're realizing with institutions, and you think about plan sponsors and those types of things, well, maybe we can do the same thing for institutions. And can we start creating that dialogue? And we're calling it a bit of a flywheel. Like, can we create a flywheel where we leverage our relationships with retail customers, but also with institutions?
Over the last 45 years, Middlefield has helped Canadians build and preserve wealth through active management. They offer diversified strategies and specialized funds in sectors like real estate and healthcare, all while paying regular distributions. Through a curated suite of top-rated ETFs and mutual funds, Middlefield's portfolio managers have intimate knowledge of their portfolio holdings, positioning their funds with purpose. Ask your financial advisor about Middlefield or learn more at middlefield.com today. So when you talk about being, bigger than Brookfield in terms of the assets that you have, is it because you saw, here's another lever of growth? Or did something change about insurance that made it feel like, maybe we need a diversifier here?
In the early 1980s, we bought MFS. So MFS is the biggest part of those assets. It's 600 billion, more than 650 billion probably, US assets under management. And we bought MFS for about $50 or $100 million in the early 1980s because we needed to own the fund manufacturer to sell variable annuities in the US. And now that business gives us almost $1 billion a year in income. It's worth a ton of money. And so we always had this piece, but what we weren't was, again, we were an insurance company that owned MFS. What we decided about 10 years ago, and Dean and a guy named Dean Connor, our former CEO, and Steve Peacher really drove this, where they identified, they said, we have this general account that invests in all these other things. We should be a full asset manager that has MFS that does public equities and public fixed income, but we should also do infrastructure, private credit, private fixed income.
Which is what SLC is. And real estate. And we built that out over the last 10 years. And that business has 250 billion US in third-party assets and close to 180 billion Canadian in our own general account assets. And that step to create that breadth of the business was really important. And what it does is different asset classes respond differently to different economic conditions. I mean, public equities love low interest rates. Private credit and real estate have different sort of drivers behind them. And so having a full set of asset management capabilities gives us the ability to talk to different fund managers, to talk about different cycles, to understand the economies in different ways and bring different capabilities. And so to me, that's what that decision to create that breadth across the full sort of gambit of asset management is what turned us to an asset manager. It's interesting. You keep mentioning MFS, and some on the street, some analysts, they view it as a bit of a problem child because it has seen a lot of outflows, and people will say that it's because the investment industry has shifted away from mutual funds and the style of investing. People love AI stocks. They love that kind of story, and maybe they're shying away from the kind of investments that MFS invests in, but it's pretty consistent, the outflows that we see. Why is that happening?
Well, if you told me I'd have run a business and the problem child would make close to $1 billion a year, would have 650 billion in assets, would have an ROE that's almost, it's almost infinite because they use very little capital. Would that billion that gives us 90% of that billion in cash flow every year, that the money they give us would fund all the acquisitions that we've done? I'd say I'll accept that problem child. I look at it and say, are they in a difficult part of the cycle? Absolutely. Are they looking at branching out into active ETFs? Are they doing more on the private fixed income? Yes. Do their clients understand how they invest and why they invest and what they get? The answer is yes. So I think that they're in outflows. Part of that is the cycle. They still do a very good job for their clients.
What do you mean the cycle? We're at record highs.
Yeah. Well, that's I think the cycle has been, there's a lot of cash on the sidelines, right? There's $6 trillion in the US on the sidelines. So there's a lot of cash on the sidelines right now. There's a lot of uncertainty in the world right now. We're also at an unprecedented run in the bull market. Like we've never seen a bull market run like we've had recently. And you've seen that driven by the Mag 7. So it's a very different environment than we've ever seen before. And that cycle will change over time. So the way they invest is really a very fundamental investment approach. And I feel really good about that. And they're in outflows, but SLC is in inflows, right? So I think that balance, and at some point in time, there may be a cycle that favors them that doesn't favor SLC, and you'll see those split. But if we're bringing good value to our clients, if we're creating good investment performance, if we have good distribution capabilities, having that sort of full gambit, I think is really good for us. Them building out active ETFs is really important. Them building out private
when
fixed
do those
income,
happen?
Public fixed income is really important.
When does that happen?
They're doing that now.
They're doing it now.
They're doing it now. So they're already out in the market. They're out in the market with those vehicles. And it's just a matter of the flows sort of coming to them. And
I feel like you kind of answered my question, was like, how do you tolerate this? Because you've used the cash that you're getting from it to go and do great returning deals.
Right.
And I wonder if, maybe you're talking about Asia when you talk about that, because another big part of the Sun Life story is you guys are massive in Asia, and Asia is becoming massive for Sun Life.
Asia is the fastest growing insurance market in the world. And at some point, asset management is a little bit more nascent there. We'll be one of the fastest growing asset management places in the world. And our history there, our businesses there, our footprint there, the diversity of our footprint there is going to serve us really well. I remember I met with one of the largest investors in the world, and they had their entire team, their global team that came to see us. And he was arguing that the only place he wanted to, the one guy, that the key insurance investor was saying, the only place I want to invest in insurance is in Asia. I don't want to invest in insurance in any other market. And I said, listen, I get the Asia piece. We think Canada is also pretty good and it's different. And we sort of walked through that and the health space. And I think that, but if you went back to his premise, and if you look at where we expect our fastest growing insurance to be, it's Asia. I took over Asia for Sun Life in 2012.
And core markets in Asia include what?
We've been in Hong Kong for the longest, almost 130 years. We've been in the Philippines for close to 130 years. We're in Indonesia, Vietnam, Malaysia, India, Singapore, and China. And so we have a big footprint, and then we have a high net worth business that we sell through Hong Kong, Singapore, and Dubai. And so that's based out of Bermuda. And so that footprint is really strong. When I took over Asia in 2012, we were making $100 million a year, and we'd been making $100 million a year for a long time. And I remember when I went over there, Dean said, it feels like we're playing not to lose instead of playing to win. And our job is to play to win there. And the other thing he said to me was, I keep hearing we can't attract the best people because at 100 million, we're smaller than the big competitors there. He goes, your job is to get the best people. That's all I did for 5 years. We went from 100 million in income to almost 350 in income in 5 years.
So was that the key change?
Those two things were the key change. And we went from 42 million in value of new business, which is the value of your sales, to almost 250. And today we're making about 200 million a quarter in income versus 100 million a year. And the key change was just, I think, playing to win. And the other thing, playing to win, bring in the best people, and then recognizing that you can't compete in a market unless you have all the distribution capabilities. So most of the markets in Asia are roughly 40% agency, 40% bank assurance, 20% other, broker or digital. If you want to have market share, you can't just be an agency, or you can't just be in bank assurance, or you can't just be in digital or brokerage. You have to be in all three. And so fundamentally since 2012, we've been building out that core distribution strength so that we could gain market share.
For a decade, the Murray Wealth Group has been dedicated to disciplined, long-term investing. The result? Their Global Equity Growth Fund boasts an impressive 14% compound return since inception, and they're proud to celebrate their 10-year anniversary of building wealth for investors across Canada. Discover how the Murray Wealth Group can work for you by visiting murraywealthgroup.com. World-class investing, wealth built together. Basically, insurance and wealth management products are a product for people who have money, right? Like ultimately. And so you do need wealth to increase in that area. And for a long time, that is what was happening, and it is still happening. But I wonder how you think about tariffs and the shift that the U.S. is trying to force with onshoring and nearshoring at the expense of Asia, at the expense of places like China and Vietnam, and whether that is a growth risk for Sun Life.
So a couple of things. First, the biggest impact on us from tariffs is the economic impacts, and you've seen that it's been the volatility's been more. So if you look at currency and the change in U.S. dollar versus Canada, it's changed more quickly than we've seen in the past. You've seen pressure on interest rates. You've seen equity markets be a little bit more volatile. Now, if you went in aggregate, everything's actually behaved quite well, right? The equity markets aren't far off where they were. Interest rates aren't far off where they were. Credit's been pretty good. But the volatility's been more. And there's certainly pressure on countries. So you've seen new deals with China, new deals with Vietnam, with Japan. My view is that our diversity helps us to manage that. It's really hard to say because it's so new what's going to happen. But if I stood back and I looked at the change, if I started in the US, I would say a lot of this may not be bad for the US economy. And I know sometimes in Canada, we may want to believe differently, but if the US is bringing jobs back and circulating on different things, and if you watch what Trump does, he's stopped short of creating really bad economic conditions. I think you could argue that over the next 3 to 5 years, this could actually, his changes may be quite good for the U.S. economy. What it does longer term, I think, is more questionable because it's forcing countries to think about other relationships and where they are. Asia is already doing that, and if you think about most of the countries in Asia, their biggest trading partner is not the U.S., it's China or other places. And they use the U.S. as a balance. And I do think there'll be some impact on the economies, but it may not be as great in Asia. And these are developing economies anyways.
You haven't trimmed your growth prospects in Asia or China?
No. I think in Asia, so you say the U.S., lots of change, but not really economic conditions that are looking bad. And in Asia, I think Asia is going to grow through it. And there might be certain countries that are more impacted, but it may not be impacted by the tariffs. It may be impacted by other things. So I think Asia is going to find its way to grow through it. There's incredible resilience. There's 4 billion people that live in Asia. So it's going to work its way through. I worry a little bit about Canada because Canada has such an important trading relationship with the U.S. I really like what the government's doing currently. I really like how we're focused on building the Canadian economy and finding different ways through it. I do think there may be some pain in the short term. In many ways, I look at this and think Canada may come out of this stronger. Now, it may take a couple of years. It's definitely going to take a combination of governments doing the right things, of businesses doing the right things, of governments and businesses working together. It's about the economy and finding ways to do that. We're definitely going to have to find ways to bring some of our trade that's with the U.S. and make it domestic. And that's why the government's looking at infrastructure builds, and that's why they're looking at provincial tariffs. We're definitely going to have to find ways to create new trade relationships with other countries. And I think that's got to be a systematic approach. And we're definitely going to then have to find a way to optimize the trade we do with the U.S. because that's always going to be there. And these aren't exactly the right numbers, but just for conceptually, I've been using with people to sort of say, if 60 to 70% of the Canadian economy is domestic, and let's say 35% is international trade, 80% of that 35 is with the US. We basically have to take 1/3 of that and find ways to make it domestic, 1/3 and find new trade relationships, and 1/3 with the US that we optimize. And it's doable. It's doable. We have great people here. We have the world's second most important natural resources. So it's doable, but it's going to take time. And I think the Canadian economy is going to feel some pressure, and what the government has to do and what businesses have to do is step up to that.
So it's interesting you say that the government is taking the right approach here, even though there might be some near-term pain and digesting what tariffs mean for our economy. And we're already starting to see signs of strain. Are the conditions right broadly, either for a company like Sun Life or for other Canadian companies to invest? I think the list of complaints by Canadian companies, whether it's regulatory, whether it's interprovincial burden, whether it's, how we strategically partner with other countries is very long. What we do with our natural resources is very long. Do you feel like those list of complaints are finally being heard?
I'll give you an example, because I think examples make the best way of telling it. When I first became CFO in 2017, we started to talk to OSFI, the federal regulator of banks and insurance companies, about the capital charge related to infrastructure. And we believed it was too high. And it sort of came out of the new capital rules that OSFI had put in place, LICAT. And under the MCCSR rules.
It's like you have.
So the MCCSR rules was the capital charge used to be 2.3% of the asset. It went to 6%. And
meaning you have to hold
more capital, which made investing in infrastructure more expensive. OSFI's now reduced the capital charge on infrastructure from 6 to 3 if it's infrastructure to support the Canadian economy. And I think that's a great gesture by the government to say, insurance companies, come and help us build the infrastructure and be part of it. Infrastructure is a great asset for us. When I talked about the long-term liabilities, it's a great asset for us. And this is the government recognizing that they can help to support that and create an ecosystem that works together. So those types of things, those types of decisions were harder to come by than they are today. And I think that we're recognizing that we have to work together, find ways to build the economy.
Okay, so some progress
there. Some
there.
Progress, yeah.
You keep talking about that alternative platform, infrastructure, real estate, credit. And I feel like that's huge right now. Everybody's looking for that. 60-40, maybe not. Maybe it's not just stocks and bonds. Maybe now it is alternatives. But I feel like nobody adequately addresses the liquidity problem and the transparency problem, right? Yeah. Like, how do you know what your assets are worth? How transparent is it? And if there is an issue, how do you get out? Like, how does a huge asset manager like Sun Life think about that?
Okay, so if we looked at institutional investors we deal with, they will typically have 15% plus or minus 5 inside of alternatives, right? And that's actually been growing. So if you think about the world's largest institutional investors, if this works for them, why wouldn't it work for the retail investor? And that's the percentage that we're sort of targeting. You may know we did a transaction in Canada with Scotia to bring alternative asset management through Scotia McLeod. And that's the goal. It's around 15% high net worth individuals. They have to understand that these assets are different. They don't have the same liquidity. So you have to think about what those liquidity events look like. And you don't want it to be
What do they look like? It looks like you can't get your money out.
Well, no, I don't think that's true.
Okay.
But I think it's around. It has to be a structured set of valuations and liquidity of when it comes. And when we build retail versions of the product, we think specifically about what liquidity comes, what it looks like, and how do we translate that to the investor. And you're not wrong that you're going to need a certain amount of wealth before you can be a retail investor. So institutional investors, they understand the liquidity aspects of it. And then the high net worth, I would say, retail investor also understands the liquidity aspects of it. So if you thought about 15%, that would sort of give you the notional amount that we think you should have.
Let's use an example, since you love examples. Think about real estate right now, and certain pockets of Canadian real estate are certainly under duress. The condo market, for example. And there's a number of funds that have either shut down or been gated And does that not highlight kind of what I'm concerned about with this area of the market? Because you're like, oh, I need real estate exposure, but in this way, you could lose it all.
I think you want a real estate manager who understands what they're doing, right? So if you look at our portfolio will have a mixture of different things. Cold storage has been a really good asset class for us. Multi-residential buildings has become a really good asset class where you're selling to people who are renting. Office space maybe has not been as good. Other sort of buildings are good. So I think it's about the diversity of where you're investing, of investing in fundamentals of those businesses and understanding the fundamentals. We had
like right now, would you fund a condo developer? Well,
let me give you an actual example. Okay. I might have the time frame a little wrong, but 10 or 15 years ago, we started to pivot away from retail space because we were looking and seeing the shift to people buying online, and we were worried about retail space. So we started to shift away from that. We had even started to shift away from office space even prior to COVID. So I think that, and then understanding office space all isn't the same either. If you looked at really class A buildings, the best buildings in the best cities, people are still going to the offices there. If you went downgrade into not as high class buildings, that's where they're struggling more. So I think you really have to understand the trends, where the trends are going, what you're investing in. One of the things I love about the real estate investment is, and our real estate arm, is that we get indications of how the economy is working that you don't get from other things. Like you see people not going to retail stores, you see people not going to office buildings, but you see data centers coming forward, you see cold storage coming forward. So you get an understanding of how the economy is working as well. So I think in the real estate space, not all real estate is created equal. I'll give you an example. We just launched a fund out of Japan, our Asia fund out of BGO, Bento Green Oak. That fund was significantly oversubscribed by institutional investors, and the fund has had tremendous performance, and that's in Japan. So I think understanding the trends, going into the right real estate sort of pieces makes sense, and geography makes a ton of difference, and including up to things now like climate change play into it. Where are you located?
Well, I just want to go back to my question on condos then. Yeah. Like, do you have a foresight?
We don't do a lot of condo investing, but we do some multi-res where it's apartments.
Is it under duress?
Well, it's funny. I was just talking to our head of real estate, Sunny Kelsey, just before I came over here. And one of the things that when you think about multi-res, there is less and less being built because the cost of building them is actually more than the appraised value when it gets done. And what's that's going to end up doing is driving up the cost of the rent over the long term. So I think some multi-res in the right locations can actually be a very good real estate investment at this time. But again, I would encourage thinking about portfolio, right? So that you have to have somebody who's, our global mindset helps. I think having a portfolio of investments helps, and sort of understanding how to invest in those pieces. And any one building can be, any one class, you can have bad and good inside of that class.
I mean, let's talk about the real estate exposure that Sun Life has. I follow the quarterly results. Yeah. I know there's those, quote unquote, non-core charges related to real estate. That's US commercial. Is that right?
Yeah.
But it keeps happening. And so I just wonder, at what point is it not non-core? Do you have to just reevaluate what is this stuff worth?
So one of the things we do is because we think long-term. So we have an expected return from real estate, which is 7.5%. And if you looked over a period of time, that's exactly what we're having. Now, the last couple of years, it's been less than that, but over an extended period, we're still in line with our 7.5% assumption. And that's what we're looking for. This has certainly been a more difficult environment, especially in North America, for real estate. And you're seeing those charges come through. But if we look at it over a long period of time, we're still very consistent with that 7.5% expectation.
And have you transacted? Have you sold any of those assets or tried to?
Oh, we're buying and selling all the time. Like literally our real estate portfolio is is going to be, if you include BGO and third parties, probably 100 billion.
But of the, I guess, like the problem children in that you're taking a charge on, are those assets that you're interested in continuing to hold?
It's not, well, so if you think about, we have a 7.5 expectation, probably roughly half of that, say, is income on the properties, probably a little bit more, but say half of that is income on the properties. We're not, when you see that charge come through, typically we're earning about zero, right? So we take 7.5% our expected return through our underlying earnings, and then the difference of that comes through the reported earnings charge. So we're actually not losing money there. We're actually sort of more or less breaking even, but that's how it sort of comes through the earnings reported.
Accountants.
Yeah, exactly. And if we earn more than 7.5, then it's a positive. And we try to structure that so it's roughly half the time we earn more, half the time we earn less. It's just we've been in that transition phase where it's been under for probably almost 2 years now, but understandably.
Is it getting better? Or do you see an inflection?
It's so hard to get investments people to say, but I would say that our belief is that it's bottoming out.
Why?
I think the charge is coming down. The cost of building compared to the valuation. So nobody's building new. So what happens over time is then people start to raise the cost because there's less inventory. So I think these are cycles we've seen before.
So this doesn't feel like any different from what previous cycles
I think we still believe in the real estate sector, but again, it's not. You have to think about categories and differences and being across different markets and different countries.
Let's talk about U.S. health insurance. Yep. I don't know if you've watched some of these insurers over the last couple of months. I don't know how you couldn't. It's been a bit of a train wreck, but the bottom line seems to be medical costs are going up in an unexpected way for these insurers, and they're not able to reprice their offerings to like match the higher costs in time. Basically, maybe they'll be able to reprice next year, but they're offside definitely for a year. And you've got a bit of health exposure in the U.S., not just health, but also dental. And I'd be curious your thoughts on whether you're seeing costs go up there. But can you shed some insight into like what is going on?
Medical costs around the world have been rising for a long time. When we do our business in the U.S., we have 3 businesses. We have a group benefits, employee benefits business, which is life and LTD. So it's not really related to the cost of medical. Dental, which is it's a different thing. A lot of the cost inflation is around hospitalization, pharmaceuticals, new pharmaceuticals. So it's dental's not really impacted by that. It's impacted by other things, but not really impacted by that rise. And then the third is our stop loss business, which does have elements of that. We're one of the largest stop loss players in the US. We've been doing it for many years.
And is stop loss, like, can you think of it as like reinsurance?
It's you could think of it like reinsurance. It sort of says if a lot of employers self-insure, but what they say is if for an individual the cost goes over a certain amount, they want to have reinsurance on it. So we've been providing that. All of those businesses, one of the beauties of them is that they're repriceable. So you might think of it like property and casualty business where, property and casualty gets hit by a hurricane or by flooding. They have to pay out a lot of costs and then they reprice for that the next year. That's the way that those group businesses.
And your exposure is all corporate. You're not subject to whatever is going on, Medicare, Medicaid.
So in the employee benefits and the stop loss, we have no government business. In the dental business, we do have probably 80% would be either Medicare or Medicaid. So we do have that exposure there. And that's been part of it's one of the issues we've been seeing more recently. If you looked at our results, first quarter and last year, we've been seeing a higher dental claims experience. And in my mind, that's not unusual. If you think about there's literally probably close to 100 million Americans that are on Medicaid or Medicare, and they don't know. Now, we don't have all of them as clients, but we probably have close to 35 million. They're going, I may lose this dental insurance, so I better go get my teeth cleaned now, or I better go get my root canal done, or which
usage
rises,
goes up.
Usage goes up. What's typically happened, and we still expect will happen, is that the states understand that, and over time they have an algorithm that sees prices increase to offset those increased costs. Now a lot of the states are a little uncertain in terms of what's the funding look like, and so that's an area where we're working through with them. But yeah, I would say it's a fairly narrow piece of our business that's impacted by that. And even in the dental side. But do you feel
like it was because it seems like with these other companies, it was just like caught them totally off guard.
The healthcare companies are going through a much, a more fundamental sort of impact. And it literally is the cost of, it's literally the cost of healthcare and keeping up with that, and new technologies and new drugs and those types of things. One thing we did do probably about 5 years ago, we bought a company called Pinnacle Care. And Pinnacle Care was started by doctors. And you might have heard of a company like Best Doctors that helps people assess their healthcare assessment. So Pinnacle Care was like that, but it's a more concierge private service that was actually being offered to some of the wealthiest people in the United States, where they would, if they became ill, they would go to a doctor. And if they wanted a second opinion, they would go to Pinnacle Care, and Pinnacle Care would even help them get into where the best care was in the United States. What we did is we said, listen, Pinnacle Care can help us in the stop loss situation. Because what happens in stop loss is we get the most difficult and sophisticated and most expensive cases. And so by putting Pinnacle Care beside it, we're able to help the member, the patient, to find the best care. And then a lot of times you'd found they were being given treatment they didn't need, or that wasn't effective. And so we would able to take them, give them a better experience, lower the cost, which the sponsor liked, and a better experience, which the member liked, and also the lower cost was good for us. And so we created this equilibrium in our stop loss business, which has been really, really good and really unique. And part of that was a shift in our thinking from just being a benefits provider to being in the health space and helping people manage their health.
So I've asked you about MFS outflows, real estate, the U.S. situation, Asia, and you're not worried about anything, it seems.
Worried about everything, but what
kind of insurance guy are you? You're too optimistic. No, like seriously, what are you worried about?
It's these are unusual times. I worry about the stress on our people and on clients. I worry about more broadly the economies and how do they work their way through them, and the volatility that's in there. But we do have to be optimistic, right? I think people have an incredible resilience, and businesses have an incredible resilience. Early in the year, we already started to see trade to the U.S. go down. This is Canada in general. But at the same time it was going down, we started to see new trade going to new countries. Businesses pivot. Businesses change. Businesses understand. People pivot. People change. People understand. And the same with cities. Like I remember I grew up in London, Ontario, and all the head offices moved out of London. And I remember people saying, oh, London's it's over. Well, London pivoted to become a healthcare hub. Yeah. And so I think that there's incredible resilience. And if we use our capabilities, if we have good strategies, if we execute well, we'll find our way. We'll find our way through all those things. 160 years, we've actually seen all these things happen.
Well, and a global pandemic, actually.
And a global pandemic, which should have been the worst thing to ever hit an insurance company, and in many ways was a tailwind.
And so I wonder if that's kind of the foundation of your sunny disposition, because you started as CEO in 2021. So yes, you've been with the company for a while, but I can't imagine a worse time to become CEO of a life insurer when there's a global health pandemic. What were those days like?
It's interesting. I don't know if it's the worst time or not, but I will tell you that all of my interviewing for the job was done online. So I had to do, I did all my assessments. We had a sort of a assessment stage. I had to present the strategy to the board online, and I met with every single board member online for interviews.
It's like 12 people.
So, 12 people interview online. all of their research with our executive team was done online. I never would have thought that that's how the CEO process would go. So it was quite different. And when I started,
you must have amazing Zoom etiquette.
So most people in Canada would know the name Manjit Singh, right? So Manjit came in when I was, my first person I called, once I could call people, was Manjit, because Manjit was always on our list as a potential CFO candidate. I had known Manjit for a while. But my interviews with Manjit were online because it was still during COVID. I can remember in the first year as I was doing, I started to institute one-on-ones at least twice a year where I would go to my team's house and we would do a walk, or they would come to my house and we would do a walk, because that was the only way we could meet in person, was we would go outside and walk. It's actually how I found my house, because I went to Manjit's house and he lived 2 blocks from where my new house is. And that's actually one of the funny stories. People used to laugh when Manjit was CFO and I was CEO.
You lived 2 doors down from each other?
We were 2 blocks away, but I used to, during quarter ends, I would pick him up and drop him off. And that's, we would have updates on the way to the office. So that was our,
yeah. And I think I know this, but you like still do those, is it a daily coffee?
I do. Yeah, I do coffee chat. It's probably more than daily, and they're a little bit more, not quite as regimented as that. It's kind of like, who do I want to have coffee with? But I'll give you an example, and people know I do it. So I did one with 3 co-op students yesterday, and they reached out and they said they heard I do this. And so they reached out and they came up to my office, and they all take pictures when they're in the office. And so the co-op students are the most fun, but I've done it with new grads. I do it with my executive team. I do it with just people I bump into in the elevator. Yeah. So it's always fun.
It's so funny because you are you can tell like a people person, and you love the staff and are worried about them. But you also think about risk and managing risk. And so I'm curious about how you're using AI, artificial intelligence, because that must be huge, like the potential for AI. Where are you in deploying it?
Yeah, we're experimenting in every business and in corporate, and using it in different ways and finding different things we can do with it. So I mentioned Pinnacle Care. Pinnacle Care would often get doctor's notes. And we're using AI to document and analyze those doctors' notes. We're using it in call centers. We're using it in almost every aspect of the business.
And
we have a thing called
one company that you just like plop in and say, go in, or do you have to source?
Yeah, we have a strategic relationship with AWS, with Amazon, and we use Amazon for a lot of pieces, but we also use Microsoft for some, and we use, I think we even have some Google applications, right? So it's multiple organizations depending on the fit. We have something called Sun Life Ask. So it's like ChatGPT, but it's our own version, because we don't want information to go out into the public domain.
So who built that for you?
Our IT shop, and that one was built alongside of AWS. So, wow. And people love it and use it all the time. I've been thinking about different ways I can use it even better. I just went through our board meetings coming up. So we probably had 100 PowerPoints that I reviewed this weekend. And I was with a friend of mine who actually happens to work for AWS. And he's like, why did you do that? Why don't you just get AI to go through it all? I'm like, well, that's an interesting idea. There's elements but maybe I could use AI to summarize it. And maybe I could read it and go to the summary and say, do we have all of the pieces? So I think there's all kinds of different ways it can be used, and it will be used. I think that nobody should ignore it. We do a high school trainee program in our IT area. And we had 37 high school students from Toronto in our office about a month ago. And these kids asked the best questions about AI that I've seen anybody ask.
I mean, they're like native. They're almost AI native.
They're absolutely AI native. And they're saying, oh no, it's going to take away my job. They're saying exactly what you're asking. How are you using it? Where are the jobs going to be that how do I leverage it, and how do I think about it? And I give our IT guys a lot of credit for bringing in these kids. And I was like, man, these kids are smart, way smarter than I was in high school, but they're asking these types of questions, and they're saying, oh, just make it go away. It's not going to go away. It's not going to go away for anybody. I tell people, listen, yeah, every company, every person's going to adopt it. It's like, lights, it's like the internet, it's like the computer. We're not sitting here in candlelight, looking at my dad's ledger that's a paper ledger, right? Like that's not happening. So AI is coming. We're experimenting with it and trying to find the best places to use it. We are doing strategic events. Like one of the things that we are going to be doing in the fall is working with one of the consulting companies. I'm going to try to get all of our business group leaders together with all of their heads of IT, and we're going to go down to Boston. We're going to do some sessions. Everybody used to go to Silicon Valley. So these guys are just, we go to Boston. We can also do Toronto. Toronto has a great AI thing, but getting together and talking about how's this going to change the business? How are we going to use it? How are we going to retrain our people? Because that's also going to be important.
Well, and I wonder if it affects like where you're going to grow next. A lot of people will look at, you're pretty cashed up. You're doing a bit of buybacks, but I don't think breaking the bank on them. So what are you saving it for? Would you do a tech acquisition? Where would you like to expand most? Like, is it Asia? Where do you think you can buy versus build?
So we're at an interesting inflection point in many ways. I think that we've been quite acquisitive, and we're working our way through those, right? SLC's in their earnout stage. So I want to see Steve Peacher and Sunny get through that earnout stage, which is probably the next 12 months. We've done a bunch of bank assurance transactions in Asia, which is back to that distribution thing I talked about. We're now in bank assurance agency in every market. We've got broker where any market that is big, and we've got something on technology in each of the markets. So I think Manj is in a place he's working through a bunch of the bank assurance we've done. Canada, we have scale in all of our businesses, and in the US is working through its dental acquisition. So I'm actually kind of sitting back going, now I want to see you guys execute. We are doing some buybacks. I think there will be opportunities, but before you do M&A, you want to know first that you're adding either strategic capabilities or scale where it's needed.
I mean, because M&A is going crazy right now. Everybody's doing deals.
Yeah. So you want to know three things. You want to know that it's the right strategic decision, that it's going to meet your financial objectives, and that you can execute. And what I want to see is that we're ready to be able to execute. If I looked at where I see acquisitions, I think once we get through the buy-ups, we'll probably have some work. We've done a really good job, probably better than almost anybody in the insurance industry, of building out the alternative asset capabilities. But once we get through this, there's probably some specific bolt-on pieces we need to look at
in alternatives.
In alternatives. So I can see some of that. And Asia's the fastest growing, and I'm passionate about it. And so I would like to see us continue to think about, we're now a top 5 player in Asia. How do we solidify that position and keep growing there? I think can be some stuff on the wealth side in Canada, right? We could be bigger on the wealth side in Canada. And we've got Jessica Tan, who just joined us, who's amazing. And Jessica was co-CEO of Ping An, bringing a lot of really good technical skills and technology sort of commitment. So you'll see some things through there. And I think the US health group space, which is low capital, repriceable, big space to us. I think there's also opportunity. So all of them can have opportunity.
Could you take advantage of some of the stress there right now?
Well, they need to be able to execute. So we need to do our own stuff first.
Yeah.
And then they get to do the next stuff.
Okay. All right. That was close. I feel like we got some insight without knowing exactly where you could go. Before we wrap up, I like to kind of do like a rapid fire with CEOs. We talk a lot about success, but I think we learn a lot from mistakes.
Yeah.
And so, you think back on your career, what was your biggest mistake? Do you have one?
I think one of my biggest learnings, I would say, was when I was, the first business I ever ran was group retirement services for Clerica. And we had people still love that time. We had an incredible time. But when I first took over, I was a finance guy, right? I was a CFO type, and I was in the early 30s. This was a brand new business, and I had never worked in the group retirement services space. I made a lot of mistakes. I made a lot of mistakes around how to think about. I thought that all of our distribution people would think like me, like math wise, and they didn't. It was very emotional. And one of the things I'd forgotten was they're not like us. They don't start every year with a salary, and they start every year at zero, right? And I didn't realize the psychology of that area. I didn't realize of sales. I didn't realize operations and how it was so day to day. And if you didn't fix problems, they just snowballed on themselves. And so I learned so much. I was 32 years old or 33, and I learned so much. And one of the things I learned the best though was that even though I didn't know the business and even though I made mistakes, I built relationships with everybody on that team that still stay today for lots of them. And they helped me to learn how to do it the right way. They taught me because they trusted me. They knew I wasn't doing it because I had a bad intention. I was just doing it because I didn't know.
Poor boy, he doesn't know.
Exactly. This poor guy, he doesn't know. And so I think that was a big learning and so one of the things I learned as a CEO is that I should bring my skill. My financial management skill is something I have. But I need to build a team and trust them of people, including financial management, who have all the best skills. And my job is then to integrate and coordinate those skills. And back to Dean's, build the culture, get the best people.
I don't think you're going to retire, but two of your in your cohort have already retired at Manulife and Great West Life. So maybe they've got a spot for you on the golf course, or I don't know what their hobbies are. But how do you think about like that day when it comes, your legacy and what you want to leave?
Yeah, I think that I think that as CEOs, we have to be passionate about our company and passionate about our strategy and passionate about making it get better. And as soon as you don't have that passion, you should know that it's yours to pass on to somebody else. So that's the first thing. I remember my best CEO, or one of my best CEOs, I should say, some of them will be listening to this. So all of you were really good because we built a really good team in Asia. But one of my best CEOs was a lady named Riza Mantaring in the Philippines. And she was doing great. And our Philippines business was doing great. And she had a 5-year run where she had a strategy that started in 2011. And I moved there in 2012 that had done really well. And she did a second turn of the next 5 years. And so it was 10 years in. And she came to us and said, I'm going to retire. And we're like, Riza, it's going so great. Why do you want to retire? And she said, I don't have a third 5 year in me. I don't have the same passion for the next 5 years. So I'm going to go and do something else. I think that first you have to know yourself. All leaders have to know themselves. Do I have that passion to drive that change? And the thing with the CEO is it's not the change this year, it's a 5-year change. And so you have to think about it that way. The second thing you have to think about is your successor. And when are they ready, and positioning it for them. And so for me, that's the two key things. Do I have the passion? Do I have the commitment to drive those 5-year strategies? And am I getting in the way of somebody who I should be letting do it, who's ready to do it? And those are my judgment. And when I know it'll be that my time. And I'm sure that Paul and Roy did the same thing.
Kevin, thank you so much. It's been a pleasure chatting with you.
Thanks, Amber. It's always fun. And thanks for having me.
That's Kevin Strain joining us of Sun Life. We'll catch you on the next episode.